In this video, we'll use the 2024 annual report of Dr. Martens plc to calculate profitability ratios. Firstly, the gross profit margin, which is calculated by dividing the gross profit by sales. Both figures are clearly stated on the face of the profit and loss account. The companies use the term revenue rather than sales, but they mean the same thing. We can calculate that the gross profit margin for financial year 24 is 65.6% and for financial year 23 is 61.8%. So in financial year 24, for every pound of revenue, Doc Martens generated 65.6 pence of gross profit. For every pound of revenue, 34.4 pence covers cost of sales. This increase in the margin from financial year 23 to 24 is an improvement. The company is generating more gross profit for every pound of sales. Reviewing some of the investor information available from Dr. Martens identifies two main reasons for the improvement in gross profit margin. Firstly, there are more sales being made direct to the consumer in the sales mix. These have a bigger margin than wholesale sales, so the gross profit percentage for the company as a whole has increased. The second main reason for increased profitability is due to the company's supply chain improvement strategy. The operating profit margin is calculated by dividing the operating profit by sales. The operating profit is not shown on the face of the P&L, so we must calculate it by taking the gross profit and deducting the selling and admin expenses. The operating profit margin has decreased from 17.6% in financial year 23 to 13.9% in financial year 24. The company has become less profitable than in the previous financial year. For every pound of sales, the company is generating less operating profit in financial year 24, only 13.9 pence, down from 17.6 pence in financial year 23. The increase in gross margin will affect the operating margin in a positive way, since more gross profit is available to cover the overheads. For the operating profit percentage to have decreased, there must have been a considerable increase in the operating costs of the business relative to the revenue. A review of the annual report highlighted costs of new and maturing stores, cost of temporary inventory storage in the US, a small increase in marketing spend, increased depreciation and amortization, and increased interest costs. The return on shareholders' funds is calculated by dividing the profit for the year by equity. The profit for the year is easy to identify from the profit and loss account, and the total equity figure is easy to pick up in the statement of financial position. Return on shareholders' funds has decreased from 31.9% in financial year 23 to 18.8% in financial year 24. We need to consider the numerator and denominator of this fraction to gain insight into this movement. The denominator of the fraction has decreased slightly, which would have a positive effect on return on shareholders' funds. The reduction in the ratio must therefore be down to the movement in the numerator, that is, the decreased profitability, which we are aware of. The return on capital employed is calculated by dividing the operating profit by the long-term funding of the business, that is, equity plus non-current liabilities. We've already identified operating profit and equity. Here we have the non-current liabilities section of Dr. Martens' statement of financial position, which, as you can see, hasn't changed much overall from financial year 23 to 24. The return on capital employed has dropped from 21.3% in financial year 23 to 15.3% in financial year 24. The company has generated less profit from the capital funding available to it. Given that equity and non-current liabilities haven't changed much, we can see that the reduction in this ratio is due to the reduction in profitability, which we have already discussed. It's a good idea once you have finished looking at a category of ratios to summarise your findings. We could summarise here that despite an increase in gross margin, an increase in operating costs has impacted on the profitability of the organisation. This has in turn resulted in a reduction in return on shareholders' funds and return on capital employed. As part of your analysis, you'll want to take these figures and compare them to others. Here we're comparing performance in financial year 24 to financial year 23. Comparisons could also be made with previous years, competitor companies, and industry averages. If you were internal to the organisation, you may want to compare these against your target figures for the period. Whatever the comparison, have a think about why there are differences. Are the results for Dr. Martens better or worse than those being compared to? Why has this happened, and what should the company do about it?